Hello and welcome to Capital Market and the Security Analysis for Ethiopia. Today we are going to see classification and the role of financial instruments. I am Balai. This is video 4. Classification of financial instruments. Financial instruments are totally, their common name is securities, are usually divided into 4 categories. The first category is debt security, or it is a fixed income security. The income for debt security is earned when a maturity date reach. The income and the principal and the interest is at maturity dates. And also this percent is fixed. This income is fixed. The time is also fixed. It is not flexible. The other is equity security. The income is not fixed, and also the time is unlimited, as we discussed in the previous. We have discussed in the previous equity securities and the debt securities difference. The other third part of financial instrument is derivative securities. It is derivative because price of derivative security is derived from another equity or another securities based on underlying price of other security. It has no its own price. Rather, we can determine the price of derivative security based on the other securities such as debt securities or equity security or others. That's why it's called as derivative. And it is used for measuring of future risk, or it is for management of future risk. The other is the combination or hybrid securities. When we come to debt security or fixed income security, as we have said before, is includes bonds, a long-term loan made by investors to a company or to a government. Bond can be sold by government also. And bond is a long period of time, or maturity of the bond is long period of time. That's why it is called as capital market, as we have divided based on its maturities before. And the other debt securities or fixed income security part is promissory notes. For example, if a company borrows $5,000 from you and sign a promise not to repay you in 1 year with 8% interest. This is promissory notes. From its definition, promissory note means that is promise. The promise or the contracts you sign with your opposite parties, that is promissory notes. The other debt security or fixed income securities are certificate of deposits. This is a saving product issued by banks. You deposit money for a fixed time and then the bank pay you interests. This is called certificate of deposit or SD. The other is treasury bill or T-bills. This is sold by governments. It is a short time maturity. It is less than 1 year and has different maturity time. For example, it has 28 days maturity or or 15 days maturity, or 91 days maturity, or 180 days maturities, and the final one is 364 or 365 days or less than 1 year. That means this is treasury bills, but its income is fixed, and also they are short-term security. The other is commercial paper, or a short-term unsecured debt issued by large companies to raise money quickly. This is commercial paper. It is unsecured and they issued by companies to raise money quickly. For example, it is used for, especially when a company faces a problem with working capital. Example, a company sells commercial paper worth of 100,000 at $97,000. This is the discounts. So you can get $3,000 at the end of maturity date. Today you'll give 98,000. At that time you get, that is $1,000. This is called commercial paper. Such securities are usually issued for the fixed term, and in the end the issuer redeems them. The issuer redeem all of these securities at the end or at the maturity date. That's why it is fixed term. In the event of bankruptcy, the debt security holders, that is creditors, have preferred right over equity security holders. Comparing with equity security, preferential rights is given for debt security holders. As you know before, in different finance subjects, we have seen that there is a common stock and a preferred stock. From their name, preferred stock means that is debt security, and the common stock is share. Share you purchase from bank, for example. If you are shareholder for the bank, then if there is a bankruptcy, you will get at the end, or you will get a residual amount after every liability is paid. That's why the other half, the debt security, has preferential rights, and the equity security can get residual amounts, and other income is not fixed for equity security. They can get the income of equity securities based on the performance of the company. The second one is equity securities. They include share or stock which represent ownership interest held by shareholders of the organization. As we said, in the event of bankruptcy, the equity holders have residual interests or claims that remain after all obligations have been paid out to debt security holders. As we said, the residual is for stockholders or for common stockholders. The third one is derivative securities. Derivative securities are generally promises or commitments to deliver underlying products, that means commodity, stock, bonds, currencies, interest rates, etc. at some time in the future, or a given right to buy or sell them in the future. This is for managing of your risk. You can manage your risk by purchasing things in the future, by considering different scenario, by considering different situation. Their values Their value depends on the value of underlying products and usually used is to consider and minimize a risk. That is used for minimizing or managing of a risk. But as we said, derivative security has no its own price. The price of derivative security is determined based on other underlying assets, such as bonds or other financial security. There are four main types of derivative securities. Those are future contracts. This is legally bounded. Forward contracts. This is personally you can agree with the buyer or the seller. Option contract. This is the right you can get, but there is no obligation under the option contract. There is also swaps. You can exchange or use swaps your interest with another person, that is fixed interest rate with float interest rate or other. You will see the detail of it in the future, so follow with me. When we come to future contract, it is legally binding commitment to buy or sell a standard quantity at predetermined price in the present. The future price on specified future dates. This is legally binding, future contracts. They are standardized contracts traded on an exchange and are regulated by central government bodies. So it is binded by a legal or controlled by government in another ways. And it has its own standard. When we come to forward contracts or forwards, it is privately negotiated agreement between buyer and the seller to trade an underlying product at future date at a specific price. In opposite of the future price, a forward contracts is not binded legally, but privately you can negotiate with buyer and the seller. The seller and the buyer can negotiate with each other or among themselves or in between them. It is customizable or it is flexible terms and the condition. A derivative contract between two parties to buy or sell an asset at a specified price on a future date. They are not standardized contracts, so it is opposite of future contracts, and so are not regulated at all by central government bodies like that of a future contract. In future contracts, it is regulated by central governments. In forward contracts, it is not regulated by central governments, and it has no standard. You can change, you can customize it. That is why it is customizable. The third one is option contract. Those are, as we said, are derivative securities. As we said, option contract is a contract that gives a right but not obligation. It's a contract in which the option seller guarantees to the option buyer the right, not the obligation, to enter into a transaction with the seller to either buy or sell an underlying asset at a specific price on or before a specific date. Two options are there. The first one is call option. This is the right to buy but no obligation to buy. You can call and buy, but there is no obligation. The other is put option. This is the right to sell, but there is no obligation to sell. So as we said, option contract give a right, no obligation. The other part is swap. It is derivative contract through which two parties exchange the cash flows or liability from two different financial instruments. For example, interest rate swap, currency swap. It's interest rate swap. How? If your interest rates is flexible, or floating, and my interest rate is fixed, and you need to have fixed interest rates, and I need to have flexible interest rates so we can swap in between us. That is why, or that is the means of swap. Why? To avoid a risk. You think having a fixed interest rate has no risk, because if the time is changed, there is a risk. And for me, having flexible exchange rates or interest rates or floating interest rates is free from risk. I wanted to have that floating so we can swap in between us. And also in currency, there is a currency swap. The others. Classification of financial instruments. Financial instruments, or totally their common name is securities, are usually divided into four categories. The first category is debt security, or it is a fixed income security. The income for debt security is earned when a maturity dates reach. The income and the principal and the interest is at maturity dates, and also this percent is fixed. This income is fixed. The time is also fixed. It is not flexible. The other is equity security. The income is not fixed. It is hybrid. Let us come to the role of financial instruments. What is the function of financial instruments? Financial instruments are used for a variety of purposes. Among others, financial instrument use is a means of raising capital. You can raise your capital by issuing your financial instruments. You see how you raise a capital. Governments and the business use financial instruments to raise capital by issuing stock in the bonds so as to meet their financial needs of funds or fund projects. Governments issue treasury bills and collect money. This is a means of raising capital. The other role of financial instrument is means of payment. We all use financial instrument to make payment for goods and the service that we need. Debt payments, project payment, bill payments, employee benefit payment, the like. The other roles of financial instrument is means of storing value. Financial instruments such as stock, bond, and other securities have value and can be bought and sold. Receivables represented by outstanding invoice can be sold to factoring companies, which then collect amounts out. This is how financial instruments store value. The other role of financial instrument is means of transferring risks, especially under derivative contracts. Investors purchase financial instruments like stock options, interest rate swaps, currency futures to protect against loss to offset the risk of changes in exchange rates. So, to offset a risk of changes, you can purchase or you can transfer your risk to another parties by purchasing stock or securities or other financial instruments. The other role of financial instrument is it is a means of speculation. Investors purchase option contract, which gives the rights but not the obligation to buy or sell stock, currency in the commodity such as gold within a set period of time in the future. they use for speculation purpose, because those investors believe they will profit from the price change. This is how we think in the future, or by considering the future situation, we can speculate. Let us come to risk in the return profile for different security. Which one is risky? Which one is less risky? So, depending on a risk management subjects, and also depending on different finance subjects, and as we know before, high risk is high return, as you know. If there is high risk, there is high return. If there is low risk, there is low return. So depending on that, a return, when we draw our return risk in the returns on horizontal and vertical graph, or in y and x, if we increase our return, our risk also increase. That is, very high risk is equity security. Medium risk is hybrid. Very low risk is bond. Why there such is happen? Why bond is low risk and why equity is high risk? I need this all answer under comments. Please write your answer under my YouTube comments. Why bond is less risk and equity is high risk, and why high return is from equity and low return is from bond. For investors, which one is very best, and what kinds of environmental analysis we have to conduct to invest our money on bond or equity, or when we have to invest on equity and when we have to invest on our bonds. Because if you invest on equity, you can get a high return, and there is also high risk, it says. If you invest your money on bonds, you get low return and also you face low risk. My question is, why such is happened? Please clearly explain for me. And then I will see if that is correct, I will say correct. If that is not correct, I will come with evidence. So I hope you will do this one. This is the end of today's program. And I thank you for your reviews. Please, if you like, subscribe to my YouTube and share it. For the next time, we will see financial institution and the different issues. Okay? Have a nice time. My YouTube is, as you know, at Balaizode 1986. Subscribe and also share only if you like. Otherwise, don't worry. Thank you.